We'll be looking for a massive spike in red volume bars. We'll be looking for the news headline to be just nothing but just, pain on Wall Street and investors and bankruptcies.
Hmm.
We'll probably see gold bottom. Gold and miners will start to build a bottom and actually start to perform first. They did that in 2008. They bottomed 3 or 4 months before the stock market did. So that'll be an early warning sign. I'm just like what we see in gold right now. When we look at in terms of gold, if we were to, we've had this big move up in gold after a multi-year pause. We had the same just before 2008. We had a multi-year pause. During this pause in gold, stocks and real estate took off. Nobody wanted boring gold. They went elsewhere. But then suddenly people got nervous and they cashed out of everything else. They start to move into gold to get it out of the financial system.
Investors should watch for a sharp spike in red volume bars and headlines signaling widespread financial distress, such as bankruptcies and Wall Street turmoil. Historically, gold and gold miners tend to bottom and recover before the broader stock market, as seen in 2008 when they bottomed 3 to 4 months earlier. A similar pattern may unfold now. After a multi-year pause, gold has surged, mirroring the pre-2008 period when gold was overlooked in favor of booming stocks and real estate. As financial fears grow, investors often shift to gold to protect against currency risks and systemic instability. The speaker, ChrisVermeulen, a seasoned financial analyst, trader, and founder of the Technical Traders, explains that the bond market remains under pressure as bond prices fall while rates stay high or rise. Uncertainty surrounds the Fed's actions, which are often reactionary and delayed. A stock market crash in early 2025 could shift the Fed's stance dramatically, but their unpredictability makes relying on news and economic data misleading. Instead, focus on market trends. Falling bond prices and rising yields signal investors lack confidence in rate cuts anytime soon. Following the money and charts provides more precise insights than speculative headlines. After analyzing the S&P 500 supercycle from the 2009 lows to recent highs, Chris highlights that a Fibonacci retracement suggests a potential market pullback of 32 to 42%, possibly extending to 50%. Breaking the 2022 low could trigger panic selling, signaling a washout bottom before a significant reset. Historical corrections like the 50% drops in 2008 show such declines are typical during unwinding events caused by market manipulation and QE. Current signals, such as falling job openings despite low unemployment, point to mixed economic conditions. Depending on the nature of the market reset, the correction could unfold gradually over the years, like in 2000, or rapidly, like in 2008. Check out the video for more details, and if you enjoy the content, please like and subscribe for the latest updates.
I mean, I've been out of favor for the bond market for a long time, and we continue to see bonds move down. And that's simply if rates aren't going down or if rates are going up, we're going to see bonds go in the opposite direction, which is down. So people definitely are worried that rates aren't going to move, and potentially rates are want to get maybe even go up. Who knows what the Fed will do? They're super unpredictable. I mean, they have no control. All these, you just showed these percentages of what people are thinking is going to happen. If the stock market was to crash and really tank the second half of January or February, it'll be a totally different game changer. What the Fed will probably say going forward, and I find they're generally reactionary and they're delayed. This is like the first time I've really noticed the big rate cut that they did last time. That was huge. They were like front running the market, and now they're not doing it. They go from saying we're going to cut a ton to now we're not cutting at all. So that's why I don't like news and economic data. It just gets in the way, and it really messes with people's minds. The reality is we have to follow the money, follow the charts, and when you look at yields, when you look at bond prices falling, it's telling us that people right now don't have faith that the rates are going down anytime soon. It's in a downtrend at the SP 500. So if we go and we take a look from the SP 500, so the last major super cycle that was in here, we'll use a Fibonacci retracement. So we go from the 2009 lows and we go all the way to this next major cycle high. This gives us our two downside targets from the high. So if we go from the high, we could see a market pullback about 32 to about 42%. Somewhere in there is that's the most kind of ideal pullback in the market. Now it could go a lot further, but somewhere around that 40-45 mark will be very critical for a couple of reasons. We need to break the 2022 low here, which that would pierce it, and that will put people into a feeding frenzy of like, get me out, like the bottom is broken, like, and that's usually what can signal a washout low, and then we go into a big reset. So when we look at the big picture, this isn't that bad. A 43% to 50% pullback is actually the same pullbacks that we've seen during other resets. So when we go back to the 2000 pullback, we're looking at 50% to 2008, over 50%. So it's just a typical type of market correction, and people don't want to live it or go through it again. But that's the reality. When there's an unwinding event of multiple waves of manipulation in the market and QE and all that stuff, it does a lot of damage when there's unwinding. I think a good chart of that almost just shows, like here in the number of job openings per employee for unemployed person. Typically, when we see volatility, we see the number of job openings change. And the market, I believe, was topping in 2015, 2016. All the signs were there. We were kind of like right where we are right now in terms of a lot of asset classes starting to come to life and weakening. But then Trump got in and created a whole new push higher. And then the whole market was about to top just before COVID, and we were about to go off another cliff. COVID quickly reset things quickly and then took off again, and we had all kinds of stimulus. And then we put in another top, and we're seeing the number of job openings fall, which is really interesting because job openings continue to fall, yet unemployment is falling as well. So we have some very weird mixed signals out there, and I think it's just the scenario that's unfolding here is pointing to another big correction based on the big chart picture. You got to step way back and be like, okay, this could take a year and a half to unfold. This could take like 3 years to unfold. It depends if it's like the 2000 kind of slower unwinding. It took 3 years of falling pricing, or if it's like 2008, where it's more also a huge washout crash, an event that wipes things out really quickly.
In a crosstalk with David Lynn, Chris points out that the current cycle remains favorable for precious metals, with gold and energy stocks performing well as the stock market peaks. Gold could rise further in the next 1 to 2 months, potentially reaching $3,000. However, a pullback similar to 2008's 34% drop may occur as the economy shifts, bringing gold back to around $2,000 during the next bear market phase. This pullback could present a significant buying opportunity, potentially leading to a multi-year rally with gold reaching $5,000 to $10,000. In the short term, the outlook for gold is bullish to neutral, with a likely sell-off later this year or early next year. Moreover, the US dollar is a safe, low-volatility investment during uncertain times, allowing for larger allocations. The dollar index is breaking out of a multi-year base and could rise to 116 to 120 or higher, applying pressure on gold. Historically, the dollar has surged during significant bear markets like 2001 and 2008. Cash, or the dollar index, is currently the safest play as markets transition, offering protection while equities face potential declines. Now, let's get back to the interview.
Still favorable for precious metals. And the cycle chart that I have here shows that typically we see gold and energy stocks, both do very well as the stock market is trying to put in a peak. And we're seeing both gold and energy stocks have been on fire, trading near and at all-time highs. So because we're in this stage, it's a long-term cycle. I believe I'm still bullish on gold. I still think gold can move higher over the next 1-2 months, and maybe even push up to 3,000. It might have one more push higher here. So I am neutral to bullish over the next 1 to 2 months for gold. I do think when the economy changes and turns and things start to sell off, I believe gold will have a pullback. And we did see it pull back about 34% in 2008. And the upside target somewhere, gold could reach to about 3,050. And if we were to have that kind of type of pullback, we could come right back down to, this 2,000 mark in the next bear market phase. And that would be equivalent to what we saw in 2008 percentage wise. It'll be settling right into this last breakout. And then it'll be the kind of probably the last major opportunity to get back into gold, very similar to over here, where we go into a 3, 4, 5-year rally where gold could, go $3, $5, $10,000. Who knows how this next phase will go? So short-term gold, 1 to 2 months, I'm bullish to neutral. This year, though, I do think it's going to eventually get sold into and start to sell off. Yeah. And the question is, when does that bottom come in? Late this year, beginning of next year? I'm not sure. I think the dollar is a very safe play. It's a low volatility move, which means you can put more money to work or all your money to work. I like the US dollar. If we take a look at the dollar index, this is the monthly chart. It's breaking out of a multi-year base. It's starting to push higher. I do think we're going to see the dollar push quite a bit higher and get up into this 116, potentially 120 or higher. That is going to apply pressure on gold. During the last major bear markets in 2000, we saw the dollar scream higher. 2008, it screamed higher. We are making a series of higher lows, a series of higher highs. And so I think the low volatility, super boring trade, but a very strong one is to be long the dollar index at this point. And when people get nervous and liquidate and all the countries are falling apart, the US dollar index tends to move higher as a defensive play.
And okay, cash then. Are you staying in cash right now?
Right now we're in cash and we're in the dollar index. That's kind of the play because right now, as I mentioned, we go back to our charts here. We're in this transition phase, so there isn't a safe spot at the moment other than a cash or holding U.S. dollars. So that's where we are, and the dollar is starting to move up. And so if this stock market keeps falling, anyone who's holding equities are going to get hit pretty hard, and we definitely don't want to be holding that. So cash or the dollar is, to me, the place to be.
The financial landscape suggests caution as markets face potential corrections and economic shifts. Precious metals and the US dollar offer safe haven opportunities, with gold poised for both short-term gains and long-term rallies, while the dollar provides stability during volatility. Investors should monitor key indicators like volume spikes, bond trends, and the S&P 500's retracement levels to navigate these uncertain times effectively. How can investors best prepare for a potential market correction while balancing exposure to gold and the US dollar? What specific signals should investors watch to identify the bottom of the current market cycle? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.